Let's start off with what your investment philosophy is telling you right now about what's actually happening, because it seems as though the good news is kind of absorbed and priced in, and the bad news ignored entirely.
I guess the bad news is being ignored, but I think we need to look at the quantum of money that's being pushed into the economy. And we've been doing a bit of research on this, looking at how this time round is different from the financial crisis in 2008. And based on our calculations, we see that the amount of money that's been pumped into the system is probably 4 times what it was in 2008. So I think, it would be silly, really, to try and beat the Fed, as the common parlance suggests, given the quantum of money that's going into the markets.
Jim, absolutely. In your notes, you're saying that approaching long-term investing by pension funds in particular has been sort of recalibrated over the last few years. Has that recalibration also accelerated with what's been going on in the last few months?
Yes, I really think this is something that we are seeing happening right now in a lot of pension funds globally. And I guess back in 2008, we had a similar event in terms of the equity markets being shaken up by the global financial crisis, and many pension funds reacted by going into lower risk assets. The issue we have right now is that lower risk assets are yielding absolutely zero returns at a time where you've got longevity increasing and a lot of pension funds having to engage in a policy called liability matching. So that's why I think investors who are looking for low-risk assets to service these liabilities will increasingly look to equity markets to satisfy that part of the portfolio. Now, in particular, we think that Asian equities are quite attractive from that point of view, because a lot of the companies in European markets and US markets, they have much more leveraged balance sheets. They've had to issue equity and cut back on dividends at a time where companies in Asia, because they are run conservatively, have the ability to increase dividends.
I suppose particularly Japanese ones, and hence you've got a long list of these companies which may well have significant dividend growth looking ahead. Tell us about the whole process here and how you pick those particular stocks.
Okay, so what we've identified in Japan is that companies have been conservatively run for many, many years, and they've had this kind of stakeholder management policy where companies don't just look after shareholders, but look after employees, they look after their suppliers. And for that reason, they've got very, very conservative balance sheets. Now, over the course of the last few years, you've had a number of activist investors starting to engage with management teams in Japanese companies to actually encourage these companies to pay out more of their retained earnings as dividends. Now, that's increasingly beginning to happen. So what we've done is we've looked at, rather than dividend yield as the basic valuation metric to identify whether a company has got a decent payout, we've looked at the dividend growth. And actually, in the case of Japanese companies, we've identified many companies which are growing their dividends at more than 20% every single year. So rather than look at the valuation today, on today's dividend yield, you can look at, let's say, 2 or 3 years' time and identify that these companies have got incredibly strong growth potential. So I think the issue we've had is that many global equity income funds have held onto UK or US stocks, which are now having to cut dividends. We see that with the US banks. In the case of Japanese companies, they're comfortable growing dividends despite the fact that the economy is not in good shape. Now, we've got some good examples of that. Mizuho, for example, one of the financial names. Some of the telcos like KDDI and NTT Docomo, they're increasing dividends at a time where the economy is struggling. And that, I think, gives us a sense that these companies are reacting to shareholder engagement.
Jim, you talk about it being a dividend growth story, Japan a good market for it. Yet when you take a look at Nomura's exposure to dividend growth plays in Japan, it's pretty small. Why is that, and what would reverse that position?
Okay, so what we've done in terms of the stocks that we've identified, we wanted to get a basket of stocks to reflect the geographic weights of the region. If you take the biggest single market in Asia Pacific, it happens to be Japan. The next one is China. Then we have Taiwan and Korea. So I think if you look at relative to that geographical base, then we've got a decent representation coming from Japan. I guess in the case of Korea, we've got big companies like Samsung Electronics, where we've got dividend growth over the last 5 years, averaging an annual rate of 25% increase. That's a very significant number. We're also seeing that in Japanese stocks as well. So I think in terms of where we've chosen to put the basket, we've tried to go for big liquid companies. Now, what we've identified is that global investors, when they actually generate these income portfolios, they're looking for very large market capitalizations, and that's something we just don't find in Japan to the same extent as, let's say, markets like the US.
But there are concerns about a bubble economy in Japan. How might that play out? How much of a risk is that?
So I think, with Japan, we see an element of great caution in the way that companies are run. So if I look at some of the pharmaceuticals names, for example, in Japan, you find that the yield is relatively modest. These names are trading at about 2% dividend yield, but the dividend cover is 9.4 times. Now, if you look at, say, the global equity income healthcare names, the companies like Roche, for example, Sanofi, their dividend cover is just 1.5 times. So the Japanese names, very, very cautious, and that means that their ability to grow dividends, especially at a difficult time for the market, is much better. And actually, if I look at the average dividend growth for the large-cap Japanese pharma names, it's 7.5% over the last 10 years, whereas for the global popular favorites is 4.4%. So I think caution is something which will benefit these companies in the future. And if we look at equities overall, if you look at the best dividend growth of any equity market globally in the last 10 years, it has in fact been Japan.